we started researching the space in 2005. And for those with long memories, 2005 was a year of big hurricanes in the US. So Hurricane Katrina, which many people will know of, hit New Orleans. And there were also two other fairly material hurricanes in 2005. So spreads widened significantly as people repriced the risk of hurricanes. Now, we were lucky. We invested in 2007 because we saw that spread widening to really attractive levels. And I think I remember 2017, the yield on our portfolio was, call it 15%. Now, we had probably 10 years after 2007 where there was very little natural catastrophe activity that impacted the industry and the space of ILS. So spreads gradually kind of cranked down. I mean, we still made money every year, but they were kind of lower. And then there was this essentially big change from 2017 to 2024, where in most of those years, we've had more than $100 billion of annual industry losses. Now, that was from a starting point of low spreads or lower spreads in 2017. So we have a more remote risk portfolio, so we still made money above cash every year, 2017 to 2024. But a lot of people, unfortunately, didn't because they were maybe taking more risk. But if you fast forward to 23, you'd had kind of like a number of years of these much heavier, more painful losses, a lot of capital exiting the space, climate change lurking in the background as a reason for people to stop allocating or deallocate. And as I mentioned earlier, in a different question, which was around the losses that people made on the asset side of their balance sheet, which was 2022. So reinsurers invest in fixed income portfolios on a levered basis. Bond yields rose. They made a lot of losses. That was combined with losses on the cat side. So spreads rose really materially in 2023. So they were extremely attractive, extremely wide as we've ever seen in the 17 years. They've come in a little bit over the last 2 years, but still really attractive. So if 2023 was a 10 out of 10, it's kind of an 8.5 out of 10 today.